Welcome back to the channel, guys, and if this is your first time joining me, welcome to the channel. So if you watched my last video, you will know that the wedge pattern is one of my top 3 patterns to determine when a reversal may be about to happen. Here I want to quickly go over what the wedge patterns are and how these patterns form before we get into 3 great tips on how to actually trade them. It's important you watch the first 2 sections to be able to fully benefit from the strategies at the end, so make sure to watch the whole video. I am producing 2 videos each and every week packed with forex tips, tricks and strategies. So be sure to smash that subscribe button so you don't miss out on any future content. Okay, let's get into it. So first up, what is a wedge pattern? Before you can successfully trade these patterns, you need to understand what they show and how they form. A wedge pattern, like a trend, is characterized by higher highs and higher lows in the rising wedge, and lower highs and lower lows in the falling wedge. The difference is that the wedge patterns have both a support line drawn joining the lows and a resistance line drawn which joins the highs. In the wedge pattern, these lines are at different angles, which means they converge as you go through the pattern. The 2 reversal patterns are the rising wedge and the falling wedge. The rising wedges themselves slope up and are a bearish reversal signal. The falling wedges slope down and are a bullish reversal signal. Okay, so how do they form? The rising wedge forms after a period of bearish momentum. Buyers at this point manage to take over from the bears, which is why the market continues to make higher highs. However, with each retracement to that support line, the battle between the buyers and the sellers gets shorter and shorter. Imagine a spring that is getting more and more compressed. Eventually that spring will release, and this is where the breakout happens. Conversely, the falling wedge appears after a period of bullish momentum. Opposite to the rising wedge, the sellers are in control in this pattern, which is why the market continues to make lower lows. Again, the battle is increasing and coming to a climax as price moves towards the end of the wedge, and this climax usually comes in the form of a breakout to the upside. So let's get on to the 3 tips on how to trade wedge patterns. Okay, so now I want to get into where you can trade these patterns, 2 different methods of entering, and a final tip on where you can place your stop loss. By the way, guys, if you want any more questions answered on trading these patterns, leave me a comment below. I will always respond to questions. Okay, so my favorite place to trade these patterns is in an uptrend or a downtrend. If the market is in an uptrend and begins to retrace towards the trend line, i.e. undergo bearish momentum, then I will look for a falling wedge to form. As that formation takes shape, I will look for price to break out of the resistance level and reverse to then continue the trend. Here's an example of an uptrend on the US dollar Swiss franc chart. The market started retracing towards this trend line and formed this falling wedge. Interestingly, it looked like the market was about to break out to the downside of this pattern here, but it turned out to be a fake out. The market then duly reversed from this fake out and broke out of the resistance line to continue its bullish momentum. If the market is in a downtrend, then I will look for a rising wedge to form in a retracement to the trend line. I will then look for price to break out of the support level to indicate the market is about to reverse and continue that downward move. Here's a downtrend in the Euro-US dollar. At this point, the market reversed and started to head back up. A wedge formed, and towards the end of the wedge, the market duly broke out of the support level and bearish momentum then ensued. Right, so let's now look at 2 different methods of entering. So it's really important to emphasize here that you should wait until the pattern is complete before trading it as a reversal pattern. So how do you know when the pattern is complete? Well, if the pattern has touched the support and resistance lines at least 5 times. In the ascending wedge, this is most likely to be 3 times at the resistance level and twice at the support level. In the descending wedge, this would most likely be 3 times at the support level and twice at the resistance level. Okay, so now the juicy stuff, the entry. By the way, guys, if you are getting value from this video, smash that like button. The 2 most traded and successful methods are the break of the support line in the rising wedge or the break of the resistance line in the falling wedge, and the retest of these same lines after a break. So the break of the support or resistance level is to wait until price has broken above the resistance line in a falling wedge and the support line in the rising wedge, and this is really important, closes above this level. Don't try and get into the market before it has closed out for the day, because a reversal may still happen and you could be the victim of a fake out. I personally like to make sure that there is a strong bullish or bearish candle. That is, a relatively long candle with very small wicks to show that there is a lot of buyers or sellers behind that move. The retest strategy is to wait until price breaks out of the wedge pattern and then reverses to retest that resistance level in the falling wedge or the support level in the rising wedge, and then entering the market at this point. This is a pretty non-aggressive strategy, and although you are likely to get stopped out less doing it this way, you will also miss out more opportunities in wedges that don't perform a retest. As you can see from our previous two examples, neither retested the support or resistance line. So, the crucial stop-loss placement. Now, I don't think I need to remind you that you should always use a stop loss, but here we go anyway. You should always use a stop loss. I always place my stop loss just above the last high of the rising wedge and just below the last low of the falling wedge. This is because a rise or fall above this level invalidates the potential following move, whether that be a bullish move in the case of the falling wedge or a bearish move in the case of the rising wedge. Of course, it does also depend on the risk that placing your stop here will cause. If it is much over 1% of your total capital, then the risk is too great. Okay guys, so there you have it. The wedge patterns are awesome patterns to indicate when a reversal is about to happen, and then trade the ensuing move. Of course, they should be used in conjunction with a base strategy, which incorporates further indicators to reinforce the entry level you are looking at. That's why I have created a 100% free ebook for you called the 3-Step Trading System, which details the basic strategy that I started out with to trade successfully in the markets. Simply go to www.theposhenglishtrader.com/3steps to download that now completely free. Once again, simply type into your browser address bar www.theposhenglishtrader.com/3steps, or simply click on the link in the video description below. Don't forget to hit that subscribe button to be notified of my future videos. Okay guys, until next time.